What is happening, Best Ever community? This is Matt Faircloth, and I am your brand new host for the Best Ever CRE show. I am excited to bring on a friend of mine. We're going to talk about something that you might not think is exciting, but we're going to make it exciting because we're going to talk about taxes today, y'all. Let's go. We're bringing on my friend Amanda. Amanda is a fellow Bigger Pockets author. She is the author of Tax Strategies for Savvy Real Estate Investors. That's you. You're a savvy real estate investor, so you should read that book, Tax Strategies for Savvy Real Estate Investors. And you want to go next level, then you should also read her second book, the book on advanced tax strategies. And you should also check out her company, Keystone CPA. Amanda, welcome to the Best Ever CRE show today.
Yes, thank you so much for having me, Matt. I'm so excited to be here. It's my first time on the show.
They come back again. It's cool because you weren't interviewed by me, so you got to come back. But yeah, that's awesome.
Yes.
I'm super, super glad to break you into the Best Ever CRE show myself. That's awesome. So, welcome. All right.
Yes.
So, I want to hop in to something now because we are broadcasting. We're recording this episode on November the 14th. 2014, and we just had a new election, right? You and I are going to break down, I'm going to make sure this gets broadcast very soon after this recording date, because every time there is an election, Amanda, there are administrative changes that happen, and us as real estate professionals, or even dare I say business owners, need to be aware of how the rules are changing, because there's an old adage I say, teach me the rules and I'll play the game. I do not have the rule book. I vote for who's going to make a new rule book, and then a person comes in, they make a rule book, and you and I need to learn to play by it, right? Talk me through real quick. Let's look back the last 4 years under the Biden administration, okay? And by the way, Best Ever listeners, Amanda and I are not advocating for one party, one candidate, nothing, so leave all your political rocks you want to throw. I don't care whether or not your person won. We all have one vote, and now that vote has been cast, we have one business that needs to abide by the rules that are going to be set by the candidate that did win. So let's leave all of our whatever you got about politics aside. Now we need to go and play the game that politician is going to put in place. Sound good, Best Ever listeners? All right, let's go. Amanda, look back the last 4 years under the Biden administration, under what tax strategies for real estate investors has looked like and what the rules were that we needed to play by.
Yeah, I have to say the last several years have been really good for real estate investors and business owners. And obviously our audience is all real estate investors, but important to understand that as investors, we are also business owners. So whenever you hear people talk about tax benefits for business, they're also talking about real estate as well. What's really interesting is that the last 4 years under Biden administration, there hasn't been a lot of tax changes. That means prior to Biden taking office, Trump had enacted a lot of tax incentives while he was in office, and those were basically all in effect in the last 4 years. And as we know, for real estate investors, it's been a pretty good ride, right? We still have 1031 exchange where we can sell our real estate and defer the taxes forever if we follow all the rules. We have bonus depreciation in the last couple years, and real estate brokers, property managers have the ability to not pay tax on up to 20% of the income that's generated. Yeah, I would say the last 4 years has been really good for real estate investors. And during the election, at least for me as a CPA real estate investor and a business owner, I was really anxious to see what happens with the benefits we've been enjoying in the last couple of years. Because when Trump initially put in a lot of these tax benefits, they were what we consider temporary benefits. Temporary meaning they're not going to last forever. Current law is that a lot of these benefits that we've been enjoying expires at the end of next year. So end of 2025, they are set to go away.
So, but by the way, are they allowed to, is that just part of the law that all things are temporary? Because he could say it's permanent, it's forever, and then whoever steps in after him would say, you know what, just kidding about that whole forever thing. We're going to make a new rule and we're going to overwrite that whole thing. So for somebody to try and lock in a tax law forever, it's all good until they're not in office anymore. Is that a right way to look at it?
For sure. You could set a law that is permanent. So if we say it's permanent.
Ever with an A on the end, not a R. Right. Yeah.
Yes. It could be changed based on the next administration, or even that same administration could just change it. Your original question is, why are these temporary then? Why do we even have temporary tax breaks? The reason is because of the way the law works in terms of funding. So when you give a tax break, it impacts the federal budget. Depending on what the expected impact of a specific law is, oftentimes they are temporary, because for it to be permanent, you need specific types of vote, majority vote, and everyone has to agree. And so unless you have a really great piece of legislation that everybody supports and it's not going to increase our deficit, most of the tax benefits we see are temporary in nature. So just like bonus depreciation, when we started out having 100%, it dwindles slowly, and you're like, why do we even do that? You know how crazy it is to have this change every single year. But one of the main reasons is because based on the law, it wasn't able to be permanent. There are things that are just temporary versus permanent too.
Is that because that the government, let's get into the, again, not talking about a party or whatever, just the government in general, right? Is that because they don't want to deal with finding out, okay, if I give this tax credit for bonus depreciation or whatever, it's going to create a deficit of X amount of dollars in projections. If the law was not in place, there would have been X amount of tax revenue, and because I'm giving that tax credit now, I now have a deficit. And if I make it temporary, I don't have to find other money to fill that hole
to pay for
as a politician. Is that really what you're saying without saying it?
Yeah, exactly. From a high level perspective, that's what we're looking at. That's how they determine it, right? Is this something that we can pay for? Just like budgeting for personal, right? This is how much money I have. This is how much I can spend it. I mean, you know, based on how much I have, this is how much I think I could carry my business or my real estate for X number of years. It's not going to be indefinite, right?
Yeah, so they can just say, okay, we'll just make it temporarily and we'll hope that this, you know, like let's say, for example, is something like bonus depreciation credits, right? It has created more real estate transaction, has created more economic growth, has created more investment in not just real estate. You can apply bonus depreciation to all kinds of things, including capital equipment for a factory, certain vehicles or whatever. All those things certainly can get applied to bonus depreciation. So you could say that because we created this, it spurred economic growth. Now, you can't project for that as a politician. You can cross your fingers and hope for it, though. You know,
there are really smart people who project that, though.
Yeah, and they're always right, aren't they? So I want to rewind to one thing that you said. I'm just curious on the show because people say things. I'm like, oh, that's interesting. Let's talk about that. You said something about the first 20% you can write off as a business owner, as a real estate investor of revenue. Can you just tell me a little bit more? I want to make sure I'm doing that too, and all of our best investors are doing it. So tell me more about that 20% nugget you dropped out there. Hey guys, hope you're loving this free education here on our YouTube channel. And if you guys love free stuff, I got more free stuff for you. Go to DeRosaGroup.com/tools, and you will see a bunch of free stuff that we've got out there. Everything from a superpower assessment to determine what your multifamily superpower is, all the way down to a free book on how to buy and find apartment buildings for you guys, even a free underwriting tool. It's all there. Go to DeRosaGroup.com/tools and grab some more free stuff. Grab that link down below and let's head back to some free education on our YouTube channel.
Yeah, it's really interesting. This law change came out several years ago. Like I said, it actually was enacted when Trump was in office. In the tax world, we call it Qualified Business Income Deduction, so QBI for short, or that's what us CPA nerds call it.
You all you CPAs love to abbreviate this stuff. Everything's got an
acronyms,
acronym,
right?
Doesn't it? Okay, all right. Go ahead with your acronym.
It's funny because when we hire new team members, we have a whole sheet of acronyms. Like that's your first assignment is to memorize what all these are. So QBI, Qualified Business Income Deduction.
Okay.
What does this mean? So qualified business, there's certain types of business income. Real estate is one of them, property management, rental income. So certain types of qualified business income might be eligible where the first 20% of income is not taxed. So an example could be you are a real estate syndicator, you get acquisition fees of $100,000. Under QBI, maybe you can write off $20,000 of it immediately, so you're only paying taxes on $80,000 as a starting point. You still get all your regular write-off, but at least that first 20% could be tax deductible. Let's say your net income from being a syndicator is $100,000. You can not pay tax on up to $20,000 of that. under Qualified Business Income Deduction. When it first came out several years ago, part of what we do with clients is review prior year tax returns, and I've seen that missed a lot, right? But I thought it's new. It's a new thing. People don't really know us. Over time, people will just get to know it. But even today, just yesterday, I reviewed a tax return for a new client that was not claiming Qualified Business Income Deduction. So if this is something that you've not heard of before, definitely take a look at your tax return. It is something that we're seeing missed more than I would like to see because it's been around for quite some time.
And that's real dollars to your pocket, best ever listeners, because, Amanda, correct me if I'm wrong, so if I can take 20% off of my net income after I take all my other losses and expenses and apply some depreciation to money I made, whatever I got left, 100K, then I can take off that first 20%. If I don't do that, I'm paying tax on that money
On the whole thing.
Unnecessarily, right?
Yes, exactly.
Real dollars. Okay.
Now, the 20% is the maximum, so there's a bunch of different detailed calculations in the tax world in terms of how much. So not everybody gets exactly 20%, but that would be the maximum. This has really benefited a lot of our clients in real estate because it applies to rental income. It applies to syndication income, brokerage, all those different types of income. Currently, it's in effect another one of those things that is set to expire, or we call sunset, at the end of next year.
No, we're just going to stop doing it. It's going to go away, but it's called sunset. Isn't that a nice, pretty way to say it?
Sunset,
Yeah.
yeah.